I've been around long enough to watch the economy rise and collapse more times than most people can count. 14 recessions so far. 14! And I'll probably witness another one or two before I'm done. That's just how the world works. The economy doesn't move in a straight line. It breathes. It expands, it contracts, it swells with optimism, and then snaps back with fear. It's the tide of capitalism, rolling in, rolling out, completely unstoppable and completely predictable in the long run. You don't control those waves, but you can learn how to surf them. And that's what I want to get into today. How to position yourself so that when the next downturn arrives, and believe me, it will arrive, you're not just holding on by your fingertips. You're actually moving ahead while everyone else is slipping backward. Most people approach recessions the wrong way. They think downturns are a signal to hide under the table, guard every penny, and pray for the storm to end. And honestly, I get it. When the news turns dark, when layoffs spread like wildfire, when fear starts to drip into every conversation, instinct tells you to retreat and protect yourself. But here's the truth I learned through more than 7 decades of investing. Recessions aren't when wealth disappears. Recessions are when wealth changes hands. They're the moments when the brave, the prepared, and the patient step forward and build fortunes, quietly, decisively, while everyone else is frozen by panic. Let me take you back to 2008, the financial crisis, the worst economic disaster since the Great Depression. Every headline was terrifying. Banks collapsing, iconic companies crumbling, families losing homes they had worked their entire lives to keep. Fear wasn't just in the air, it was everywhere. Smart people, seasoned investors, executives who had seen multiple crashes before, they were all running, selling, escaping. The entire market was in full-blown panic mode. And in the middle of that chaos, I wrote an op-ed for the New York Times. The headline was simple: Buy American. I am. People thought I had lost my mind. They said I was ignoring reality, but I wasn't ignoring anything. I was paying attention to something others couldn't see through the fog: overwhelming fear. And fear is a signal. I've said it my entire career. Be fearful when others are greedy, and greedy when others are fearful. So I bought, not a little, a lot. Goldman Sachs, General Electric, Dow Chemical, Swiss Re. I deployed billions while the crowd was sprinting in the opposite direction. And what happened? Those investments didn't just work, they performed spectacularly, adding billions to Berkshire's long-term value. Not because I'm some kind of genius, I'm not. But I understand the nature of recessions. They're clearance sales on great businesses. That's all a downturn is, a discount period disguised as a disaster. Think about it like this. Imagine your favorite store suddenly puts everything on sale. Half off, 60% off, 70% off. What do? You don't run away. You don't panic. You stock up. You buy the things you've always wanted but never felt justified paying full price for. Yet with stocks, the moment prices fall, people do the complete opposite. They panic sell the very things they should be loading up on. That's the tragedy and the opportunity. Now, let me be absolutely clear. Recessions aren't fun. They hurt real families, real workers, real communities. And if you're unprepared, if you're drowning in debt, living paycheck to paycheck, or stretched so thin that a single unexpected shock breaks everything, a recession can be devastating. That's why preparation isn't optional. It's everything. So, let's talk strategy. Let me walk you through exactly how I've prepared for downturns for decades and how you can apply the same principles.
Step 1. Cash is king going into a recession. Yes, I often remind people that cash loses value to inflation over time, and that's still true. But downturns and normal periods are two completely different worlds. During stable years, you want your capital working, compounding, growing. But heading into a recession, you want liquidity. You need dry powder, money ready to deploy when the world goes on sale. Because when a recession hits, it hits everything. Stocks fall, real estate drops, businesses get marked down across the board, and the people who have cash, real reserves, can take advantage of those prices. But if you're fully invested with no wiggle room, you're stuck watching opportunities pass you by while your portfolio sinks with the tide. So, how much cash should you keep? That depends on your age, your stability, and your tolerance for risk. But at the very least, you should have 6 months of expenses set aside. More if your job isn't secure, more if you're older. And on top of that, you need a separate investment reserve, cash you don't rely on, cash you can put to work aggressively when markets collapse. At Berkshire, I've always held large cash balances for exactly this reason. People used to shake their heads. Warren, you're sitting on $100 billion in cash. Why aren't you investing it? But I wasn't being timid. I was being patient. I was waiting for the moment when great companies would drop to irresistible prices. And in 2008, when the financial world was falling apart, I was ready. I didn't need permission. I didn't need financing. I had cash, and cash is opportunity. Now, the second element of this entire strategy, and this is absolutely critical, is knowing in advance what you're going to buy when the next recession rolls in. Because let me tell you something, when the economy starts shaking, when the headlines turn blood red, when your friends are panicking and your coworkers are suddenly experts in doom, that is the worst time to make decisions. Your brain gets hijacked by fear. Your judgment blurs. And if you're making investment choices in the heat of that moment, you're almost guaranteed to make the wrong ones. So you prepare ahead of time. Long before the storm clouds appear, you sit down and build what I like to call your recession shopping list. A list of the companies you'd love to own if only their price tags were more reasonable. That's what I've always done. I focus on quality. Businesses with durable competitive advantages, fortress-like balance sheets, and the kind of products people will still use when times are tough. I'm not collecting bargains that fall apart the moment you touch them. A weak business is still a weak business at any price, but a great business offered at a discount, that's where the magic happens. So, you begin the work now. You identify 10, 15, maybe even 20 companies that you admire. You study them,
You understand how they make money, where they're vulnerable, what gives them an edge, and what their true intrinsic value really is. And then, when the recession finally hits and prices drop like stones, you don't have to scramble. You don't hesitate. You already know exactly what you want, and you simply act. Let me give you an example from my own life. Back in 1963, American Express was nearly crushed by the infamous salad oil scandal. Yes, it sounds almost humorous today, but at the time it was deadly serious. A subsidiary had guaranteed fraudulent loans. When the scheme collapsed, the company's reputation was thrown into chaos, and the stock nosedived. Panic everywhere. People were dumping shares left and right. But I knew American Express. I understood their brand strength, their customer loyalty, their charge card business. And critically, I knew the scandal didn't actually touch the heart of the company, the part that made them valuable. So while the crowd was running for the exits, I was buying, and not just a little. I put roughly 40% of my entire partnership's capital into American Express. People told me I was insane. The stock was dropping every day. The news was ugly. But I had done the homework. I knew what the business was worth, and I knew it was being offered at a fire sale price. That single investment multiplied in value many times over the following decades. It generated hundreds of millions of dollars for Berkshire, and it never would have happened if I had let fear drown out my analysis. That's why I say one of the most important parts of investing, especially in recessions, is psychological. You must train your mind to stay calm, stay rational, and stay focused on the facts instead of the noise. That discipline is built now, not during the crisis. Now let's move to the fourth part of the strategy, and I cannot emphasize this strongly enough. Never, ever, ever invest with borrowed money. Leverage is the silent killer of investors. No mistake has destroyed more portfolios, more businesses, or more fortunes than overextending with debt. Here's what happens. When times are good, borrowing feels harmless. Stocks rise, your account balance looks healthy, and using margin seems like a smart shortcut to bigger gains. But then, the recession arrives. Markets fall. Your leveraged position collapses even faster, and if prices fall far enough, and they often do, you get the dreaded margin call. Suddenly, the lender wants their money back now. You're forced to sell at the worst moment imaginable, at the bottom, locking in catastrophic losses. It doesn't matter how brilliant you are or how promising your strategy once looked, leverage wipes you out instantly.
I've never used leverage in my personal investments. Not once. And Berkshire Hathaway uses very little. Why? Because long-term investing is a game of endurance. You build wealth by compounding year after year after year. Leverage, on the other hand, has the power to eliminate decades of progress in a single afternoon. If you're wiped out, you lose the one thing compounding requires: time. And without time, there is no recovery. There is no comeback. The game ends. Consider long-term capital management in 1998. A hedge fund run by Nobel Prize winners and mathematical geniuses, armed with models so complex most people couldn't even understand them. They believed their strategies were bulletproof, but they made one fatal mistake. They used enormous amounts of leverage. When the Russian debt crisis erupted, their positions collapsed, and the leverage magnified their losses so dramatically that they nearly toppled the entire global financial system. Intelligence couldn't save them. Sophisticated algorithms couldn't save them. Leverage crushed them. So here's your rule. No debt, no margin, no borrowed money, ever. Only invest capital you won't need for at least 5 years. Longer is even better. Because when the recession comes, and it always comes, you must be able to hold on. You must be able to ride out the panic, ignore the temporary pain, and wait patiently for the recovery. And the recovery always arrives. Maybe in a year, maybe in 2 or 3, but it returns every single time. And the people who stayed disciplined, who stayed patient, who stayed unleveraged, they're the ones who come out the other side stronger than ever.
Now, let's move to the 5th pillar of the entire recession strategy, diversification. And I don't mean the kind of diversification that most people talk about. See, a lot of investors think diversification means owning a gigantic basket of stocks, hundreds of them, sometimes even thousands through index funds, on the assumption that owning a little bit of everything equals safety. But that's not diversification, that's distraction. That's owning so much that you can't possibly understand what you hold. Real diversification, the kind that actually protects you, means owning a manageable number of excellent businesses in different industries. Not 200, not 500, more like 10 or 15, maybe 20 at the absolute most if you're incredibly involved and highly skilled at researching companies. And each one should be a business you truly understand, a business you'd be comfortable owning for a decade, a business you believe could withstand economic storms. That's genuine diversification, spreading your bets across strong, durable, time-tested companies working in different sectors of the economy. For example, you might own a bank, a consumer goods company, an insurance firm, a utility provider, maybe a railroad. These businesses operate in different environments, respond to different pressures, and carry different risk profiles. That way, if one sector takes a beating during the recession, as banks did in 2008, your entire portfolio doesn't crumble. You've got ballast. You've got stability. You've got businesses that keep chugging along even when everything else feels like it's catching fire.
And here's something most people forget about recessions. They don't hit all businesses equally. Some sectors not only survive downturns, they actually hold up surprisingly well. Utilities, for instance. People still flip their light switches, still turn on the oven, still take hot showers. Consumer staples? People still buy toothpaste, detergent, cereal, soap, toilet paper. These companies aren't flashy, they don't dominate the headlines, but they are predictable. They're steady, and during a recession, that stability is worth its weight in gold. So one smart approach is to overweight these defensive sectors before a recession hits. Build a base of dependable companies that will continue generating cash even when the economy softens. Then, once the recession arrives and the more cyclical sectors, industrials, financials, tech, travel, get hammered and discounted, you can gradually shift into those beaten-down opportunities. You maintain stability while also positioning yourself to capture the upside when the cycle turns. I remember vividly during the 2008 crisis, while banks were imploding left and right and cyclical stocks were crashing, my consumer staples positions kept doing exactly what they were supposed to do. Procter & Gamble, Johnson & Johnson, Coca-Cola, these companies never stopped generating cash. They kept paying dividends, they kept selling products people needed every single day. That consistent inflow gave me confidence. It gave me the freedom to step forward and buy more of the depressed cyclical companies because I wasn't scared my entire portfolio would evaporate. I had a stable foundation. I had smart diversification. And that stability allowed me to be aggressive when it mattered most.
That's how you position yourself for a recession. With clarity, with balance, with a portfolio built on strength, not chaos. Now on to the sixth part of the strategy, one that I learned through decades of experience and more financial scars than I care to count. Watch the balance sheets. A recession exposes weak companies faster than anything else. When revenue drops and credit tightens, businesses with too much debt suddenly can't make their payments. They stumble, then sink, then disappear altogether, and shareholders get wiped out. That's why you never fall in love with a stock just because it looks cheap. A cheap stock tied to a weak balance sheet is a value trap waiting to explode. A good business must also be financially strong, with low debt, ample cash reserves, reliable cash flows, and solid credit ratings. Many investors skip this part. They focus on the price chart, or the dividend yield, or the hype, and they ignore the financial health of the company. But when a recession arrives, that oversight can be fatal. So when you're building your shopping list, one of the very first things you check is the balance sheet. How much debt does the company carry? How consistent are their cash flows? Could they still service their debt if their revenue dropped by 20 or 30%? If the answer is anything less than a confident yes, you move on. Keep looking. Because in a recession, weak companies don't just struggle, they vanish. Meanwhile, the strong companies, they capture market share, acquire competitors, tighten their grip on the industry, and come out the other side stronger than before. Those are the companies you want to own. Let me give you a clear example. During 2008, I examined the major banks closely. Every single one of them was under pressure. Their stock prices were plunging. Their balance sheets were being questioned. But some banks had been run far more prudently than others. J.P. Morgan Chase, under Jamie Dimon, had maintained conservative capital levels, kept liquidity high, and avoided some of the most reckless behavior that other banks had indulged in. So, when I invested in the banking sector, I chose the strong ones, the ones I believed would survive the storm. And look what happened. Several banks failed. Washington Mutual collapsed. Wachovia had to be absorbed. Others barely scraped by. But the strong banks endured, stabilized, and emerged from the crisis even more dominant than before. That's the power of financial strength. That's why balance sheets matter. And that's why doing your homework, real, careful homework, is the difference between buying a future winner and buying a soon-to-be disaster. Strong businesses with strong balance sheets survive recessions. Weak ones don't. It really is that simple. Now we come to the seventh pillar of this recession strategy. And this one is less about spreadsheets and balance sheets and more about mindset. It's philosophical, but absolutely essential. You have to learn to think long-term. And when I say long-term, I don't mean a few months or even a handful of years. I'm talking about decades. 20 years, 30 years, longer if you can.
The reason is simple. Recessions are temporary. They may feel permanent when you're standing inside one. They may feel like the world is collapsing, like the economy has fallen off a cliff with no bottom in sight. But history shows us, again and again, that recessions eventually fade. They always have. They always will. For more than 200 years, the American economy has grown through wars, depressions, pandemics, political chaos, runaway inflation, bubbles, crashes, you name it. But the long-term trend? Always upward. Step back far enough, zoom out far enough, and those recessions look like dips on an otherwise rising mountain range. If you can train your mind to see the world that way, to think in long arcs instead of short snapshots, recessions transform. They stop being threats and become opportunities. Let me give you a picture. Imagine you buy a farm. Good land, fertile soil, a fair price. You know what you're doing. Now, imagine that the very next year, a terrible drought hits. The crops fail. The entire region takes a hit. Farm prices fall 30%. Do you freak out? Do you call your realtor and sell the farm at a loss? Of course not. You know droughts are temporary. The weather changes. The crops come back. You bought the farm because of its long-term productivity, not because of one bad season.
That's exactly how you should think about stocks. You're not buying ticker symbols flashing on a screen. You're buying ownership in real businesses with real employees, real products, real customers. If those businesses are good, truly good, temporary setbacks don't change their long-term value. They don't change the underlying engine that creates wealth over time. Take Coca-Cola, for example. I bought Coke in 1988. Since then, we've had recessions, financial panics, political shocks, the tech bubble, the housing collapse, even a global pandemic that shut down entire countries. Did I sell? Not once. Why? Because I bought Coke for the long haul. I believed in the brand, the distribution, the global demand. And that discipline, ignoring the noise and sticking with the long-term plan, turned that investment into one worth many, many multiples of what I originally paid. One of my favorite quotes is from my mentor, Benjamin Graham. He said, "In the short run, the stock market is a voting machine. In the long run, it's a weighing machine. In the short term, stock prices bounce around based on fear, greed, rumors, headlines, and emotion. But in the long run, prices settle at the true weight of the business, its earnings, its cash flow, its real value." So, as a long-term investor, your job is not to obsess over the voting machine. Ignore the cheers, ignore the boos. Pay attention to the weighing machine. Own good businesses, hold them through storms, and let time do the compounding for you. Now, let's talk about the eighth part of the strategy, and this might be the most important principle of all. Live below your means. Always. Not just during recessions, not just during tough years, every year. Because if you're spending everything you earn, if you're living paycheck to paycheck, even on a big salary, you have no margin of safety. You can't save, you can't invest, and you certainly can't prepare. And when a recession hits, and a recession will hit, you're exposed. One missed paycheck, one emergency bill, one unexpected layoff, and suddenly your life is in free fall. People always ask me why I still live in the same house I bought in 1958. It's not because I couldn't buy a bigger one. It's not because I couldn't afford mansions or private jets or yachts or priceless art collections. I could buy all of that 100 times over. But I don't need it. It doesn't make me happier. What makes me happy is security, a level of financial stability so solid that no recession, no crisis, no catastrophe can shake it. And that comes from living below your means, from spending less than you earn, from saving aggressively, investing regularly, and refusing to inflate your lifestyle just because your income rises. Lifestyle inflation is one of the biggest traps I see people fall into. They get a raise, and instantly their expenses rise to match it. Bigger house, new car, more expensive vacations, fancier restaurants, the outward signs of success. But inside, nothing has changed. They're still saving the same amount, or worse, saving nothing. They're just spending more. That's not success. That's frugility. The smartest way to build wealth is simple. When your income goes up, keep your lifestyle the same and invest the difference. That's how fortunes are built quietly over time. That's how you prepare for recessions. That's how you build a cushion that protects you when life throws a curveball, which it always, eventually will.
I've known countless high earners, doctors, executives, business owners making hundreds of thousands or even millions a year who end up with nothing saved. Not because they don't earn enough, but because they spend every dollar that comes in, sometimes more. And when the recession comes, when their income drops or their job disappears, they have no reserves, no savings, no protection. Don't let that be you. Build your cushion now. Build your reserves. Live like you earn half of what you really earn and invest the rest. Do that consistently, and you'll never fear a recession again. In fact, you'll welcome them because you'll be the one with cash, confidence, and opportunity while others are scrambling. That's how you achieve financial security. That's how you build freedom. And that's how you sleep soundly, no matter what the economy is doing.
Ninth thing. Stay informed, but don't drown in the noise. Stay informed, but don't let the news control your emotions. The media doesn't sell clarity. It sells fear. And during a recession, fear becomes a full-time broadcast. If you let that seep into your thinking, you'll make emotional decisions instead of rational ones. I read the news. I like to know what's going on, but I don't spend hours glued to financial channels. I look at what actually matters: the earnings, the fundamentals, the long-term outlook of the businesses I own, not the panic of the day. During the dot-com bubble, Everyone insisted the old rules didn't apply anymore. The news was celebrating people quitting their jobs to day trade tech stocks that had no earnings, no profits, no real business. I ignored it. I stuck with real companies that generated real cash. When the bubble burst and those high flyers lost 95% of their value, I didn't feel a thing because I never followed the crowd in the first place. That's the point. Stay informed, but think for yourself. Don't let the noise turn you into part of the crowd. 10th thing. Know the difference between price and value. This is one of Ben Graham's greatest teachings. Price is what you pay. Value is what you get. During a recession, prices fall, sometimes dramatically. Value doesn't fall nearly as fast. Imagine a company earning $10 million a year. In good times, the market might value it at $150 million. In a recession, fear takes over, and the price might drop to $80 million or even $60 million, even though the business is still earning close to the same $10 million. That gap between falling prices and stable value is the value investor's opportunity. When price collapses but value barely moves, the difference becomes your future return. Recessions make that gap the widest. Train yourself to look past the panic, past the price on the screen. Focus on the real worth of the business, its long-term earnings power, its competitive advantages, its economics over the next 10 or 20 years. If you know the true value, the temporary price becomes noise. 11th thing. Have an exit strategy, but not the one you think. An exit strategy doesn't mean selling because stocks fall. It means knowing what you'll do when things go right. If you invest during a recession, and you should when the opportunities are obvious, eventually those investments will recover. Some will deliver enormous gains. What's the plan for that wealth? Will you hold forever? Will you rebalance? Will you convert some gains into safer assets? Will you use the profits for retirement, education, or long-term goals? Most people think investing ends when they buy a stock. The truth is, investing ends when you achieve the goal you were investing for. Without a goal, without a plan, you're not investing. You're gambling. 12th thing. Stop trying to time the bottom. This might be the most misunderstood idea in finance. You can't time recessions. Nobody can. Not me, not economists, not the people on TV who change their predictions every week. You don't need to catch the exact bottom. You don't need perfect timing. You just need good timing. When stocks are down 30 to 40%, when fear is everywhere, when people are panicking, that's when opportunities appear. That's when you start buying. Buy some when things are clearly bad. If they go down more, buy more. If they fall even lower, buy again. That's how you get great prices without trying to be perfect. Trying to buy at the exact bottom is like trying to catch a falling knife with perfect precision. You'll hesitate, you'll wait for confirmation, and by the time you're sure, the bottom has come and gone. Remember, perfect is the enemy of profitable. 13th thing. Learn from history. Every recession is different. Different causes, different risks, different levels of pain. But recessions rhyme. They follow patterns, And those patterns contain lessons. Study them. Look at the Great Depression, the 1970 stagflation, the 1987 crash, the dot-com bubble, the 2008 financial crisis. Each one teaches something different. In the Great Depression, deflation made cash incredibly valuable. People who held cash had power. In the 1970s, inflation did the opposite. Cash melted in your hands. Two recessions, opposite outcomes. That's why context matters. What kind of recession are you facing? Deflationary? Inflationary? A credit crisis? A demand shock? The surface conditions change, but the core principles do not. Own strong businesses. Buy when others are fearful. Think decades, not months, and stay disciplined. Those rules work in every recession, in every market, in every era. Study history to avoid repeating mistakes. Let history be the teacher others ignore. 14th thing, have the courage to act. This is where most people fail. Not because they don't know what to do, not because they don't have a plan, not because they don't have cash. They fail because when the recession hits, when stocks are falling, when fear is everywhere, they freeze. It feels wrong to buy when everything is red. It feels dangerous to invest when everyone else is running. It feels scary to step in when the world seems to be collapsing. But that's exactly when courage matters most. Courage isn't something you suddenly discover in the moment. It's something you prepare for in advance. You rehearse it mentally. You visualize the recession. You imagine the fear, the headlines, the panic, and then imagine yourself staying calm, following your plan, and buying while others sell. When you've mentally visited that moment many times, the real thing won't shock you. You'll be ready. And that readiness is what separates the people who get wealthy during recessions from the people who sit on the sidelines and watch opportunity pass by. 15th thing, be patient. Patience is the least glamorous part of investing, and the most important. When you buy stocks during a recession, they don't immediately shoot upward. Sometimes they fall further. Sometimes they move sideways for months. Sometimes the recovery takes years. That's the test. If you've done your homework, if you bought strong businesses at fair or cheap prices, then the only thing left to do is wait. And waiting is hard. Waiting feels like doing nothing. But patience is the force multiplier that makes everything else work. Investing during a recession is like planting an oak tree. You plant the seed. You water it. You protect it. And then you leave it alone. You don't dig it up every week to check on it. You trust the process. And over time, slowly at first, then faster, it becomes something strong, something durable, something that lasts. Wealth built during recessions grows the same way. Bringing it all together. Recessions will come. I don't know when. Nobody does. But they will come. That's guaranteed. When they arrive, you have a choice. You can panic. You can sell. You can follow the crowd out the door and lock in regret. Or you can prepare. You can follow a plan. You can recognize the recession for what it really is, one of the greatest wealth-building opportunities you'll ever see. Build your cash reserves now. Create your shopping list of great businesses. Strengthen your financial foundation. Avoid leverage. Prepare mentally. Think in decades. Stay disciplined. Do these things, and when the next recession hits, you won't fear it. You'll use it. I'm 95 years old. I won't see many more recessions, but you will. And if you understand these principles, you'll be ready for every cycle ahead of you. Ready to survive them, ready to thrive through them, and ready to use them to create real, lasting wealth.